Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about a powerful RENKO scalping trading strategy that can potentially transform your approach to the market. This method combines the clarity of the RENKO chart with precise entries and exit rules, offering a streamlined way to identify high probability trades. Whether you are a seasoned scalper or new to the short-term trading, this strategy could be the key to improving your results. So stay tuned until the end to learn how to implement this technique and take your trading to the next level. So we start by understanding what the RENKO chart is about. And this RENKO chart are unique type of chart, price charts that solely focuses on significant price movement. They solely focus on significant price movement. The RENKO chart uses what we call bricks to represent price changes of a predetermined size for a predetermined size regardless of time elapsing. The term RENKO originated from a Japanese word renga, meaning brick, which describes the chart appearance. Now there are some several advantages that we need to take into account for traders that want to make use of the RENKO charts. One of the first advantages is the RENKO chart provides a clear trend identification. By eliminating minor price fluctuation, the RENKO chart makes it easier to spot an overall market trend. The second advantage is it helps reduce noise. The fixed brick size filters out significant price movements, allowing traders to focus on a stable market movement. The third advantage is it helps us to spot key support and resistance levels. These levels are more often apparent on the RENKO chart, aiding in identification of potential entries and exit points. So these are the advantages of the RENKO chart. So let's look at the trading strategy that we can apply using our RENKO charts, our RENKO scalping trading strategy. First of all, you would need to begin by setting your RENKO chart. You will set your RENKO chart with an appropriate brick size. For forex trading, a brick size of at least 5 or 10 pips is often effective for scalping. So you just come here, you choose your traditional box size. I will use 10 for this explanation to make it easier for us. We use a 10 brick size for this explanation. We would also have to use an indicator known as our exponential moving average, our 9 exponential moving average. You have to set your moving average length to 9 period. Then you would have to use your relative strength index. You will set it at 14 period. This is the setting for your relative strength length. So these are the settings we need in making use of this scalping strategy. After you have made your settings, you identify your trend. You look at a series of consecutive bricks in the same direction color. The minimum of 3 bricks in the same direction signifies the potential trend. The 9 EMA should align with the trend above the price for a downtrend and below the price for the uptrend. Now when price is below the EMA and you see a consecutive color of candle, of bricks rather, you can see 3 consecutive red bricks at this area. This signifies that we are in a downtrend because first of all, price is below the moving average, the exponential moving average, and price has formed 3 bricks, signifying we are in a downtrend. So this is how we can spot that. Then for an uptrend, price needs to be above the exponential moving average and form a series of three blocks moving in the same direction. So we can see three green blocks moving in the upward direction. So this is how we can identify the trend. We also make use of the RSI to confirm the trend strength. For an uptrend, the RSI should be above 50. If price is in an uptrend, it has to be above 50 in this area. And as we can see, price is making a series of green boxes, green bars to the upside. We can see that price is trading above 50 in the RSI. Then for downtrends, price for downtrends it should be below 50. And as we can see in this area, price is below 50. The RSI is below 50, so indicating that we are in a downtrend. This should help us confirm our direction of momentum. So how do we enter? We enter a long position when we see at least three consecutive green bricks. So this would have been a perfect place to enter our buy position when we see three consecutive green bricks. Not only that, we would have to see that price is above the 9 EMA, and price is significantly above the 9 EMA. We can also see that the RSI in this area is above 50. In this area, after the three bricks, is above 50. All these align to show that we are in an uptrend. While if we want to enter a short position, first of all, we have to see a series of three bricks. When we see three bricks, three short red bricks to the downside, we would enter our position after confirming that price is trading below the 9 EMA and the RSI is signifying that price is below 50. All this makes up our confidence in the trade. Then we place our stop loss just above. We set our stop loss just above the last swing high. In this area, this is where we set our stop loss. Then in terms of our long trade, we'll set our stop loss just below the last swing low. This is where we'll set our stop loss. Then for our profit target, we can implement a trailing stop. This strategy to maximize potential gains. You move your stop loss to break even after the trade moves 1.5 times of your initial risk. So when you notice price has moved to an average of 1.5, you set your stop loss at break even. Assuming this line will be our stop loss, we set it at break even. Then we trail the stop behind each new bricks. As price tends to go in our direction, you will trail your stop loss by each new bricks that is formed to maximize on your potential gain. This is how we take our stop loss, our take profit. The next step is to always manage your risks. Never risk more than 1 to 2% of your trading account on a single trade. Always aim for a minimum risk to reward of at least 1:1.5 risk to reward ratio. This should be your minimum risk to reward ratio, 1:1.5 risk to reward. You can also go for 1:2 risk to reward as your minimum, but ideally to be on the safe side of the market. This means that if you are risking 10 pips, your first take profit should be at least 15 pips. This is basically how we trade using this strategy to manage our risks. Same with your selling trade, your short trade. When you take your entry, your first take profit, you should at least go for a minimum of 1:1.5 for your first take profit target before you decide to use a trailing stop loss to scale in to secure profit as price keep on moving in your direction. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.